Hi, everyone. Glad you've joined me and Kat Paisley here today. And we're going to give you about just 15 seconds or so to make sure you're at your computer and you got your water there. And then we'll jump right in.
Sounds good. And now's your chance to settle down and get comfortable for our wonderful chat about OZ.
Yeah. All right, let's just get right into it. Everyone out there. Not going to take too long on this. So Kat and I are both really excited to be having this conversation together with you today, and we hope you are going to be as well, because we both have a long experience working in opportunity zones, and we have both have formed strong opinions, which we're going to share with you today. The topic of today's presentation is the working capital safe harbor, pitfalls involving the working capital safe harbor. We chose this topic because in the life cycle of opportunity zones, we're moving out of people forming them as we get closer and closer to, December 31st, 2026. But now a lot of clients come to us in the maintenance stage. And of the many maintenance problems we see, we often see people have questions about their working capital safe harbor written statement and compliance questions. And so we imagine that those of you who are here also are seeing this as well. So we want to go into these nuances together. I'll quickly introduce myself. Kat will then introduce herself. My name is Andrew Gradman. I'm a partner and co-chair of the tax department at Falcon Rappaport Berkman LLP. Got into opportunity zones when the statute came out. It was a thing that no one was doing, so I did it. And then it became more than half my work for pretty much each of the years since then. But I am a tax lawyer who does other things as well. I believe we, as tax professionals, are here to help you make decisions in general, just keeping in mind the bottom line. That includes the after-tax consequences, and that's what I'm here to do. Can do partnerships, sales of property, estate tax stuff. That's me. Kat, please take the...
Hi, everybody. I'm Kat Paisley, and I am a tax partner with Cherry Beckert, and I sit in our Atlanta office. For those of you not familiar with Cherry Beckert, we're an accounting, audit, and advisory firm. We cover the entire United States. I believe we're top 20 at this point, and we can help you with a wide variety of things. Feel free to reach out. And I am a self-proclaimed tax dork. So just beware, Andrew and I will definitely, we're very, very excited. And yeah. I mean, our conversations, even preparing for this, we've just kind of spun off into our own little world. And we're inviting you into that little world of ours this afternoon. So, be prepared. Feel free to put any questions in the Q&A or the chat. We will try to get to them. If we can't get to them, we will follow up with you. There were a couple questions that we got ahead of time. Again, if we can try, if we have time, we'll get to them. If not, we will get back to you. So
I definitely
all we need to know for now.
One of the perks of attending a webinar is I think that you get the right to email the presenters afterwards. So I'm certainly happy to hear from folks who don't feel that their specific question has been answered. Yeah.
Yep.
All right.
Okay. Let me. And just kind of in general, so people kind of understand our format. Again, it's a very kind of loose conversation between us. So we have this general outline, which is available for you under the resources tab. If you want to pull it up, make notes, do whatever you want to do. But this is what we'll be talking about and kind of interspersing questions that may have come up in our practices, examples of things that we have seen or experienced. And again, feel free to put any questions or comments in the chats. And if we can, we'll try and incorporate that at the appropriate times.
Yeah. So to start our conversation, let's start in the manner of Google Earth. Let's start looking at the entire world and then zoom abruptly in to the city block that we have. So this all when you're doing a return for an opportunity fund, it comes down to Form 8996. Determining whether penalties are owed or not means determining on the first page whether you passed the 90% test. Does it have, for each of the 2 periods, 90% of its property is QOZ property? For most funds that are well managed, that means that they will have chosen to own an interest in a QOZ partnership, which we wish to qualify as a QOZ business. And so we'll recite. Here, the audience here, I think, is in this space, so you are familiar with these tests: the trader business requirement, the 50% gross income standard, 70% tangible property standard, 40% intangible property standard, and the 5% non-qualified financial property standard, as well as the sin business prohibition.
One just kind of quick clarifying point is, remember, these are for the QOZB, the business. I mean, the primary test that you're passing at the fund level is the 90% deployment of funds. And hopefully, like Andrew said, you've set it up so that maybe it's another partnership down below that's your QOZB that is then that has these specific tests. Sorry, and I realize I'm pointing with my hand at my other screen. So if people are wondering why I'm pointing into space, that's why.
So the non-qualified financial property standard is what is statutory. They got borrowed from the enterprise zone business concept, and let's see, that was didn't put the years in here, but I think that's from the 90s, and then new market tax credit. I don't know if many of you in this audience have worked in the new market tax credit, but that had its own working capital constraints, and it allowed you to, as I quote, the proceeds of a capital or equity investment or loan by a CDE. I'm just quoting from the second to last paragraph on this document. And I think what's interesting from a narrative is that when Congress created the Opportunity Zone statute, they didn't put a lot of thought into the statutory text on how you would deal with working capital situations. And it I believe, only got considered in the regs when you had comment letters from Novogradac and other other audiences, and it led to over the course of the three, we had the proposed regs, the second round of proposed regs, and the final regs. There was a lot of dialogue. It was a very controversial issue, and finally emerging. And there were two corrections to the regs, which related to this topic as well. So perhaps the most controversial topic of them all, leading to, I guess we can skip to the next slide, leading to the working capital safe harbor. And these three paragraphs, lettered A, B, and C, are really the core of what we have to work with. You have to have amounts designated in writing for the development of a trade or business in a qualified opportunity zone, a written schedule consistent with the ordinary startup of a trade or business for the expenditure of the working capital assets, and you have to have the assets actually used in a manner substantially consistent with that writing and written schedule. And I think today we have a lot to talk about, but really it's the ambiguities that are baked into this language. Would you agree with that, Kat? I mean, that's really
I would agree, and I would say, like, hopefully one of the biggest takeaways people get from this is, notice in each of those paragraphs, they focus on written. This is something that, a lot of times people, especially in the real estate world, kind of fly by the seat of their pants and will document after the fact. So much of this is really dependent upon the optics of how a project looks or a deal looks. And it is crucial that you have this documented in a working and written plan. I mean, that's one thing I can't emphasize enough to my clients.
Yeah, it's become when I think of the one thing that makes me lose sleep on a client, it's are they going to have a written plan, and are they going to stick to the written plan?
Yes.
And at the risk of stating the obvious, it's, there's a cliff baked into this. If you fall short of substantially improving property by a single dollar, your only recourse is that amorphous concept reasonable cause, that you will beg the IRS for forgiveness and hope not only that they'll forgive you for your past sins, but that they'll give you an absolution for the future, which we have no reason to know that's going to happen. So
yeah. And that just trying to get in touch with them is its own challenge.
Yeah.
So.
Right. So let's start with some of the first working ambiguities, and I think that would be to just the text, right? I think one thing that fascinates me is this phrase "working capital," and I don't think this has gotten much attention. This is just something I picked up on my own, but one day I was like, oh, I wonder what working capital is. So I started looking at the text, which comprises GAAP, which is written by the FASB. And as you jump around the definitions, which I've quoted here, I learned something interesting, which is that working capital in its traditional meaning is working in the sense that it's operating. It refers to the operating cycle, the ongoing cycle of a running business. And so if you take that definition as like, GAAP tends to define things well, then then the working capital safe harbor, as we know it, for a startup business, as it's, as it's actually used in the regs, misuses the term. And I'm
Mhm.
not here to just laugh at someone for making a definitional mistake, but as lawyers, we care about definitions because it helps us know what you want to have a coherent web of definitions so you can get to the heart of an interpretation and know what Treasury meant by something. And right
Mhm.
from the get-go, they're just using a word wrong. And so it kind of puts a monkey wrench in pretty soon.
Mhm. Mhm. I mean,
Um,
almost, you kind of almost wish they had said like cash reserves or something a little more defined, because working capital, once you're in an operating business, once your business is up and running, a business that's been in place 5 to 7 years, it's going to have a very, very, very different definition of, they're going to follow kind of the traditional definition of what their working capital is versus someone that just acquired some property or is starting a business.
yeah, and I don't think it's fatal, but it's like, we're going to now step into some other terms which have definitional ambiguities. And, you know, the general trend when you're a lawyer or an educated person interpreting the language is to try and make things be coherent. And they've already demonstrated from the beginning that they didn't do that. It's like if you're on trial for a crime, it's best to wash the blood off your hands before you walk in the courtroom, just so the jury looks at you with the benefit of the doubt. And it's really hard to give Treasury and Congress the benefit of the doubt under these circumstances. Because now let's look at the next term. Um, um, Written schedule consistent with the ordinary startup of a trade or business for the expenditure of the working capital assets. Um, Again, it's like, I don't know how often you've dwelled on that term and sort of thought about it, but I mean, I have a million different definitions of what it could mean. And we know none of us know what it means, right, Kat?
Right. No, I mean, I kind of, the majority of my work is in the real estate space. So I tend to think, okay, think of a development plan, where you outline, we think it'll be X amount of time. We're going to use, Y dollars over X time and kind of work with that. But it hasn't been clearly defined. It would have been nice if they actually laid out, this is what we want to see.
Yeah, and let's unpack that for a bit because I, over the years, my understanding of this clause has changed. I think in the beginning, I accepted, I took the same definition that you just said.
Yes.
I would say to clients, it means projections. And then over time, I came to another phrase. Well, what is projection? Projections mean sources and uses with dates and amounts. And that's been sort of the hackneyed phrase I've been throwing at my clients. Give me projections, sources, uses, dates, amounts. And
And real
over,
quick, and that was
yeah.
kind of in the beginning, most people, at least most of the clients that were coming to me, already had a project in mind. They were saying, okay, I want to set up this fund because I've identified this site. So kind of the first thought was, yes, let's go that path. I think we're kind of going in the same direction.
Yeah.
It's kind of
That
the
remains, yeah, that remains a best practice. I mean, I think that when we are speaking with current clients, I continue to tell them that. I always urge my clients to have projections. Um, but now you have here's two problems. What if a client walks in the door and says, well, you weren't my professional for the last year and a half. I was self-represented and no one told me that and I have nothing. Now I have to put on my advocate hat and come up with some bullshit answer for why they did it right.
Yep.
And so now we get into, well, okay, Treasury knows what projections are. They know what that is. They didn't say that. They just said consistent with the ordinary startup trade or business. And one idea that's interested me is that you have to look at the context too. An opportunity fund is a tax motivated investment. It's one of these, we talk about substance over form and economic substance pervading the code. And yet there are also many cases in the law where in order to incentivize an activity, Congress throws money at you and says, I mean, Summa Holding is, I think, a classic case on the subject where people put disc stock into a Roth IRA. And the court says, well, that Congress said you could do that, so we're not going to look to the economic substance of that decision. And I think you could ask the same kind of analysis for many tax credits and tax motivated transactions. You could look at opportunity funds and say, Congress saw that people were not investing. in low-income communities because they're
Mhm.
bad investments economically. And so then Congress said, when you have a gain, you have 180 days to roll it over into a fund. And now that, and then you have 180 days after that ish to put the money into a QSEB, et cetera. And they put all these artificial time constraints on it. And one of my observations is that, well, you often wind up with much more equity put into a fund much too soon compared
Mhm.
to what you would typically see in a business.
Mhm.
Business people would typically be like, I would have done this with debt, but
Mhm.
I was forced to fund this with equity because the statute made me.
Or they
And
might look
so,
at it and say, like with a lot of my clients, maybe they have a schedule of capital calls. Like when we hit this milestone, or maybe your original plan is to invest $1 million, you're not giving $1 million all at once. You might be giving 100,000 at first, and then when certain milestones are met, there's a capital call and additional funding is made. Not here.
yeah. And so when you read a phrase consistent with the ordinary startup or trade of business for the expenditure of working capital assets, I mumbled, but you can read the screen.
Yeah.
Maybe if the IRS comes after you, you say, oh, yeah, I did that subject to the constraint that you made me put the money in long before it was needed.
Hmm.
And so my schedule is modified to that. And to be more specific, I mean, I'm being vague. To be more specific, in comment 2, I ask, can a QOZB just sit on cash for 31 months? And I think this is a good jumping off point for that conversation. Kat, why don't you start us off?
Um, it depends on how it's sitting. It depends. It's always a great tax answer, and legal answer. It depends. So you don't want it to just sit, in my view. Obviously, you would like to have some kind of written plan of what you're going to do, but getting back to the whole optics piece. But it can't just be sit with no plan of action. Maybe you haven't found your project, and that's I would say that's an ordinary course of business. You're looking for the right investment. You're looking for the right piece of property. Maybe something fell through, and that did happen to a lot of people. They had the funds, they had everything ready to go. They're looking at this site, somebody else swooped in and outbid them, and they lost that site. So I I would make the argument that as long as the actions that are being taken, and you want to be able to support those actions with some type of documentation that you are in pursuit of, a business or investment, whatever you're going to do, then
Yeah.
you have a little more flexibility. But you don't want it to sit there just earning interest with no activity being taken or
I'm,
investing in the stock market.
I'm going to say I hear 3 scenarios embedded in your answer. One is the client who comes to us on day one and says, I want to do a fund and I have no idea what I want to invest in. But clearly, Congress wants me to do this, so I know I'm allowed to do it.
Mhm.
What advice would you give me, given that I'm a slow thinker? And I might then I would say, okay, an ordinary startup of a trader business. Then the light bulb would go off, and I say, I have heard of a search fund or a blind fund, and I'm using words that are outside of I'm a tax lawyer, I don't have an MBA, but I understand that there are occasions in life where you hand a bunch of money to a person and you say, you're smart, figure out how to spend it, and
Yep.
don't spend it until you find the right opportunity.
Yep.
And if
Yep.
that is the ordinary startup of that kind of trader business, I think we should be able to find a way to paper up a deal with the caveat to our client that if you're going to take 24 months to figure out what you're going to do, then you then only have 7 more months to get to
Yes.
31 months, unless you have a way of getting a 62-month thing, which we'll talk about a bit later. But it can go from 31 to 62. But you just got to warn people the default is 31 months. So if
Yep.
you use up your 24, buyer beware. That's just one scenario. Another scenario you came up with is the person who had a plan and it fell through. And I think the third scenario, which motivated me to think of this about a month ago, was the client who came to me and said, hello, I have an opportunity fund. I never hired a lawyer, and I've been sitting on money for 2 months, for two
Hmm.
years. And I mean, I guess, in that case, the conversation I had with that person was, we're gonna look through your emails, and we're gonna find the email that is the most convincing story that you planned from the very beginning to look for a bit something to invest in.
Yep.
And again, who is Congress to say? I look at the Treasury, ordinary startup of a trade or business. What's going to, like, let's say this goes to tax court. I cannot wait for the day when this comes to a situation where each side hires their business school professor as an expert in tax court to testify on what is ordinary for
you
business
and I
people.
will be in the audience.
I will fly to court.
Yes, we will. We will plan it.
And like one guy's got his business school professor who's like, yeah, it's pretty ordinary for people to not plan. And then the other, the IRS's expert says, no, it's actually ordinary for people to have a very written plan. And then I'll be there and I'll testify, given that they never defined working capital and that working capital isn't even relevant in this situation. I think the taxpayer should win by default.
And I'll heckle from the crowd. Yeah,
So,
no, I think these are all three legitimate scenarios that we've seen, where, okay, I mean, the easiest one to kind of work with is the one whose project fell apart or they were outbid, I mean, that one's easy to document. The third case, you're like, okay, yeah, let's go through your emails. Let's go through your calendar. Let's find support to at least show, there was intentionality behind this. We're still trying to define what that may be, but hopefully they at least have, if they're trying to do an operating business, maybe an industry of interest, or, if they're trying to invest in real estate, a geographic location that would help support, what we're trying to do. But
yeah, and before we change slides, I guess I just owe it to the audience to acknowledge that the word schedule does have a dictionary meaning. And although Treasury, I remember, Kat, I quoted the Queen from Alice in Wonderland.
Alice in Wonderland.
Who said that words mean whatever I say they mean, or something like that. You all know, maybe it wasn't even the Queen, but words mean what I say they mean.
Yes.
So Treasury is going to pull that crap with the word working capital. But now, if I don't know if I'm going to get the same prerogative to use it for the word schedule, because the word schedule means schedule. It certainly implies dates, and if you're going to have dates, it's going to imply times. That's why I say sources, uses, amounts, and dates. But I think when I've asked my clients for this, and generally my clients I have a large fraction of clients who are not sophisticated business people, and this is sort of this is their excursion into business. They come back to me with something very informal, and I just want to for those of us who are defending clients retroactively who didn't have good representation in the beginning, I want to encourage us to take a liberal view of what a schedule is and be willing to open our eyes. And this is for you tax return preparers who are trying to decide whether you can file Form 8996. You have to sign your name.
Under penalties of perjury.
Exactly. It's your obligation to determine whether there was a written schedule or actually, let's be clear, you represent the fund and the QOZB, but there's some fine language buried in the instructions to Form 88996, which says that the fund has an obligation to inform itself of what the QOZB is up to. So you have, even if your QOZB is at arm's length from you, you have some obligation to inquire. Nevertheless, I want to encourage you, return preparers who are signing, to believe that it's a liberal thing and you don't have to be strict in the way you might have believed in deciding what a schedule is.
And I would also encourage people, for those where clients have come on after, they've already started the fund or the QOZB, maybe it started with the back of a napkin in a bar somewhere, where they just jotted down some thoughts. Okay, that's a starting point. Let's build from that. And there's no, creating the file, even if it's after the fact, creating kind of the optics of what that may be and what you're trying to do. It's easier to do now, even if you're 2 years down the road, than 6 if there's an issue with the IRS. So it's just documentation.
Yeah. And actually,
oh wait, I skipped too many pages, I think. Hang on.
This may be an occasion to skip to the end. I mean, we'll jump around if it's, of course, but
the schedule or the
can you go to page 7, I think?
This is
which is
this is
comment
page 7.
5. You're there? Yes,
Yes.
because we're going to skip because I think it's appropriate to go here. Can you modify, when can you
Yes.
modify a written statement? Because I think, again, in Kat, what you just said, there are shades of this. One shade is someone had a back of the napkin, and now you're going to elaborate it on it and crystallize it into something thorough. Another shade of this is when someone had an idea and then the property that they thought they would buy fell through.
Mhm.
And then a third version is the one, this is a lot of text, I apologize, but the third version is the one contemplated in these quoted regulations here, which is that during the coronavirus pandemic, the 31-month period, they got an extra 24 months for people. And they give you, if you're good, and they say, if you want to take advantage of the 24 months, you get the opportunity to do a new written schedule, and you have to do so within 120 days after the incident period. And I think this is an extreme case, and I want to quote and give credit to Jay Darby, an attorney in I think Massachusetts.
Whoop, sorry. Sorry.
Who wrote an article about this and even put this on my radar. I hadn't thought about this till he brought it to my attention. And he and others, Novogradac, have looked at this language, and it's responding to the coronavirus pandemic. It's giving you 24 months, saying you have 120 days to rewrite your working capital safe harbor. And then the question asks, if Treasury is choosing to be so specific about how many days you have to modify your working capital safe harbor written statement in this specific situation, by implication, does that mean that in all other cases you cannot modify your written statement? And in his article, he acknowledges that we don't know, but he then accepts the concern, the possibility that this Treasury does take this exclusive view that you cannot modify a written statement under any conditions except under these circumstances. And therefore, he wrote this article encouraging people to do so in that particular window, which I think closed 8 months ago. So that was, if you missed that, you don't have the opportunity to do it that way. And now we have to pick up the pieces and ask, okay, is this a valid concern? Or to what extent can we negotiate our way out of this theory, which says that you can never modify a written statement except via this regulatory situation related to the pandemic, et cetera. Kat, does that make sense how I just described that?
Yes. Oh, yes, it makes sense. And I just think that's an area that I don't think the IRS was practical. I mean, in what business do you not modify your written plan? I mean, it can't only happen in a pandemic. If everything always went according to plan, we may not even have as many clients as we do. We wouldn't do as much as we do, and advocate for them as much. I just think this is an area where there has to be some flexibility just to incorporate the challenges that every project and every business faces. So I don't know how you do this without being able to modify a written plan.
Yeah, I mean, and look, to put it another way, I agree with you. Today we're speaking about the working capital safe harbor, but there's a lot of stuff in the opportunity zone statute and regulations which is ambiguous. And in my prior life as a tax lawyer, I only ever wanted to advise people on things that were certainties. And if something was uncertain, I would say, don't do it. And the opportunity zone regime has given me gray area. It's added gray area to my vocabulary, because now I will say to clients, oh, this may not be allowed, but on the risk spectrum, it's a 2 out of 10. And I really don't like doing that, but this is what you get with divided Congress and a Treasury that's too busy to fix their regs. And this is an example of that, where I think Jay has raised a really good point. Nobody knows whether you can amend these things, but I am going to advocate in the following fashion. I'm going to say just what Kat said, which is that written plans and schedules include the possibility of revisions to those plans. That is how planning works. If you don't plan for contingencies, then you're not really planning. And so it's a bit analogous, I think, to the idea that you'll see in the capital asset. You're going to sell some real property, and the question is, are you holding the property for the purpose of selling it? And well, everyone's holding property for the purpose of selling it. And they acknowledge that. The question is, how prominent is that purpose? And so we acknowledge that you could have more than one purpose. And just as that's the case, we should acknowledge that you could have contingencies in your planning. And for that reason, I mean, it would be ideal for the written schedule to have all those contingencies laid out, like I'm sure they did when they landed Neil Armstrong and Buzz Aldrin on the moon. But only what's needed of you is a reasonable, I'm not going to quote this, I'm going to paraphrase this, but a reasonable written schedule, and to stay substantially consistent with that. And therefore, my interpretation, and God help me, I would love to be the expert witness on the stand, is that when unexpected things happen, you can rewrite your written schedule and period. And you just have to do it reasonably. So those of us who had clients who during the pandemic had cost overruns, or products were not being delivered from the port, or things, or it became impossible to do certain things. I at one time was paralyzed by that, and I was just, well, your written plan, you didn't plan on that, might as well close up and go home. But my thoughts really evolved on that, and I wouldn't take that same position today. I think that's not.
I would almost say if you're, kind of the fund manager or the QOZB manager of the project, you almost have an obligation to modify that written plan, because something has gone off track, something has gone awry. So are you just going to ignore it and just have here's my original plan. I know I've veered off track, but I'm just kind of operate two different paths. I mean, even if you don't maintain the original plan and then have an amendment to it, or an addendum, something that addresses, yep, we veered off track, and kind of here's how we're modifying for that.
Yeah. Would you go back up to
Extent that
page?
you're able.
Yeah. No. Would you go back to page 3 of 9, where we just were with the highlighting? I think one way of phrasing that, actually used in a manner that is substantially consistent. I think when you hear the word substantially, usually you think virtually completely or almost entirely. But I also think that word is flexible to every situation. And in this case, substantially means large enough that you can pass 5 elephants through side by side, because they can't mean anything other than that. If they meant anything other than that, it wouldn't work. It wouldn't be a sensible concept. There's clearly moral hazard involved here. Treasury, every time you have tax, there's moral hazard. Treasury and Congress are concerned that by creating any kind of election of any kind in tax, they give people the opportunity to take advantage, and that is a concern here. And so there's a bit of cops and robbers. They're the cops, we're the robbers, and we're always playing that game. But I think, and so I'm sympathetic to the desire of government and maybe of courts to interpret things narrowly and to say substantially means entirely. But just when you think about the way business works, that couldn't work here. You have to be flexible.
You have to be a little bit practical. I mean, that's okay, where to next? Where would you like me to head?
Boy, this is fun. Just why don't we just go
those
on?
in the audience are somewhat entertained by us. I know we are.
I hope so. Why don't you go on? Just see. We'll look at the next page and see if it's interesting. Okay. Why don't we go to comment 3? What we call comment 3 in our handout, and then with that weave in the preceding text, because we get a lot of. I'm sure you get a lot of people who you didn't initially work with, but they come to you later, and they didn't use a QOZB
as a separate entity.
As a separate entity. And I mean, I guess first, let's talk about what's at stake there. The working capital safe harbor is misnamed because over the course of later regulations, it turned out that you get more than simply the ability to protect your working capital. You get more protections. You also get, and these are listed here, I guess these are a total of 4 protections. One is a safe harbor on the 50% gross income standard. While you're within the working capital safe harbor period, if any gross income's derived, it'll be treated as from within the opportunity zone. And that makes a lot of sense, because let's say your money is sitting in a bank and the bank is earning interest. Is that earned within the opportunity fund zone? Excuse me. This deems it to be. You get deemed satisfaction of the intangible property standard and of the 70% property standard, and of the, did I just say it twice? No, then obviously the non-qualified financial property standard.
Mhm.
And so that's important because if you're building a project that takes, say, 24 months, and during the first, 23 months, it is not placed in service and not of anything of any kind, then the incomplete construction you have will be non-qualifying tangible property. And if you don't have a rule that says that all the tangible property will be deemed to be qualifying, then during the construction period, you're sitting on, you then for Form 8996, you fail. And you have to report the non-qualifying tangible property. I think that's an underappreciated reason why we have the working capital safe harbor, is to qualify your hulk of unconstructed building. So that is why I think you can only do a QO fund without a QOZB in those cases where you either miraculously place your property into service very quickly. For
Very quick.
example, people who do the certificate of occupancy game, and
Yep.
they buy a building that's missing a brick, and then they buy the building, and then they insert the brick.
Yep. They get
Yeah.
the CO within a few days or weeks. Yeah.
Yeah. So now the question is, okay, but now a client walks into your office, Kat, and says, "I'm so sorry, I didn't do it that way." And so the question is there, what kind of remedies do we have for them? And I'll just start with the answer that not much.
Okay, that's what I was going to say.
I don't want to trick you. I knew I'm going first because that was a trick question, and I didn't want to be unfair. Because the way I look at this in the regs, proposed or final, I don't remember, the preamble, commentators asked for this to be for all of the benefits of a QOZB to extend it to be QO funds. And Treasury said, yeah, that sounds like a good idea. Problem is, Congress only quoted all these enterprise zone features for QOZBs and not for funds, so we're statutorily prevented from doing that. And when Treasury is statutorily prevented from doing something, it means that you may be a sympathetic case, but too bad, so sad. And so, but having said that, I wonder about the reasonable cause exception. I haven't personally litigated a reasonable cause exception case, and often, the way this works is you in the audience, return preparers, discover that, let's say someone had a fund that didn't have a QOZB and they failed it. So you have to self-report the failure. And then you don't pay the penalty yet. You wait to get a letter back from Treasury saying, okay, thank you for your honesty. Would you like to claim reasonable cause? And at that point, you get to write a letter. And I think it would be wonderful if someone has had experience doing these. I've written some of these letters, but I haven't gotten responses yet. So I don't have insight. Or actually, I have one that was rejected, and so I've chosen to pursue it. Client doesn't want to pursue it, but on a pro bono basis, I'm going to pursue it because I want to explore.
You're curious.
I asked the client, look, would you let me pursue this on a pro bono basis just because I want to know what's on the inside of the monster. Yep. So hopefully I will get some insight into the way they think, because anything, I think it should be reasonable cause. If you say, I didn't do the QOZB because I didn't hire a lawyer and I didn't realize how complex this was, I would be honored to write that reasonable cause letter. But I don't know the thought psychology of the IRS in response to that.
Yeah, I've done it once, and we have tried to get a reasonable cause relief because the client's prior CPA made some mistakes on the fund return. So, we tried to take the position, we did a private letter ruling, tried to take the position, there was an error by the paid professional that they could rely upon. And we're still going back and forth trying to, we did get a response, which is first steps. And we are appreciative of that, but it's still ongoing.
Yeah. So it's that I feel like, and I wrote this article in Tax Notes State in 2022, opportunity zone planning when penalties are a certainty. And it's about the idea that a lot of our matters are going to funnel into this uh-oh, we did something wrong without intending to, we should seek
Yes.
reasonable cause. And my recommendation was for Treasury to improve their reasonable cause regulations,
Mhm.
because the public doesn't have any idea, and it's not really clear how it's going to be applied.
I mean,
Um,
I had a client where, they had a QOZB and let's use $10 million. I don't remember the exact amount, but let's say the fund raised $10 million. They deployed 90 million into their QOZB in appropriate time. But then the $1 million that was remaining was earning interest. So they weren't considered to have deployed 90% of their assets at year end because of the interest that had been earned that was now sitting in the bank account. And, I searched high and low for some exception. There is an exception for that at the QOZB level. I think it's, what was it, the second bullet point here. But, I just told them to pay our bill or some other bills just to reduce that cash. But, they didn't have 90, it was teeny, teeny, tiny. So it didn't end up being a big impact. But, I think there are some unintended consequences of the way this was set up with the working capital safe harbor being under the QOZB and some of the exceptions that are afforded there.
that's a great example. Wow. Yeah. I mean,
Yeah,
the
that
penalty.
was not a fun. I looked high and low. It was before I met you, or I would have, also sicked you on the case. Just to figure out, like, surely that was not intended. They deployed the 90%. They weren't just spending money to reduce their cash balance. So it was a little frustrating.
Yeah. Thankfully, the
But
penalty, as you said, is small, but
yes,
it still impinges upon your relationship with your client to go to
yes.
them and say, oh, by the way, you have to report a penalty. That's just,
Well, and even little things like that's why, when the accountants and the lawyers say, okay, we need to talk about your financials and where you stand at these testing periods, please don't come to us, the year after, April of the following year when we're working on your tax return. Um, if we look at it, let's say in May before the June testing period, in November before the December testing period, we may be able to remedy some of that, and then we can avoid the penalty. And communication is so important in these deals.
yeah, let's talk about that, because you and I share this experience. I think many professionals in opportunity zones share this experience, that we get to interact with our clients at specific moments, and then they go off and screw everything up. And and it really weighs heavily on me to
For all the
ask,
clients in the audience, we say that with love. We love that you screw up and give us these challenges to figure out.
That's what she says. Um, yeah, I mean, it weighs heavily on me. I want to serve as effectively as possible, and I often introspect and say, what could I be doing better to not be setting people up for failure? That's
Yeah.
weighed upon me constantly, and I've tried to make inroads on that in some ways, but I feel like there's constant learning to do, and other aspects are embedded in this program where it sets people up for failure. That's what I wrote in my article. It's designed to set people
Yep.
up for failure.
Yep.
But I think, what I've discovered is, and I think what you've also, as we've discussed, what you've discovered is when we meet with the client, setting expectations is so important.
Yes.
It's true in any professional relationship, but it just really rises to the top here. Setting the expectations that, first of all, when I say, give me your schedule, what I say to people at that moment is, okay, if you keep to this schedule, you have my blessing. You have done things right. If
Yep.
you vary from this schedule in any way, you lose my blessing, and you're doing so at your own risk. If you step one step off the path, that's where the snake could bite you. They're not just off in the mountains. They could be right off the path.
Yep.
And I think that, one could be more detailed, but the problem with opportunity zones is so much detail, so many ways you can screw up. I mean, I think you and I have seen people, for example, who, because the program artificially encourages you to put money in sooner than you need to, reasonable business people go, oh, this money shouldn't be here while I'm not using it. Let me deploy it elsewhere.
Yes.
And that is, for me, the number one thing that people do. And it feels so innocuous to them.
Yep.
And that's why I tell people schedule of sources and uses and dates and amounts, because, and then I say, if you vary from it, you lose my blessing, because obviously I could be more direct and just name that particular hazard, but this way it's like that bell should be off in the brain. Wait, I didn't put that loan to myself on my schedule. And so maybe I should check with Andrew first.
Well, and I have a client that they were considering setting up a fund and then a QOZB of their own. And we talked through, and it was large. It was going to be a minimum of $100 million. So it's any penalties that would arise from that would be large by default. And we talked about the importance of, with meet the time requirements at the fund level, get that cash out of there into your QOZB. But then down at the QOZB, they were like, okay, well, we're looking at these various real estate projects. But in the meantime, we want to use some of our funds to make loans to some of our other entities. Okay, and I think you are a little more conservative on this front than I am. But in general, depending on the client, like my default answer is you don't do that, because you could end up with non-qualifying financial property. But then if I have someone like that particular client, it's a family office, they have, an accounting department, a tax department. They are extraordinarily organized. I have a lot of faith in them. And if they have any questions or concerns, that they will reach out. We won't hear about something after the fact. So I told them, okay, make sure it is well documented, and 12 months is your max, which, as we know, really 18 months is what the regs spell out. But I don't even want to give that wiggle room, because, what if something happens? What if somebody forgets I say 12 months. Like 12 months is kind of my limit. We've had clients that, because they're good business people, have thought, I'm just going to park this in a 24-month CD. And that is, now it's a non-qualifying financial asset. So that's what I have seen is one of the biggest challenges.
Yeah, I think some people in the audience might benefit from us reminding them what the rules are and why the seemingly simple rules are making you and me so upset. Because some people may be like, well, let's just follow the rules, right? You can hold your working capital in cash or cash equivalents or debt instruments with a period of up to 18 months.
Yep.
And so you say 12 months. You told me this yesterday, so remind folks why you say 12.
I say 12 because I'm worried they're going to screw up, and they're not going to, if they say 18 and we're going to do it at 18, what happens if they've miscounted something? What happens if they go over, what happens if life gets in the way and, they hit 19 months? I like to say 12 because they can renew again, do something, another short period, something. But we've had a couple different instances where people have come to us after the fact and they were like, nope, I invested, that CD, it's a 26-month CD. And it's,
yeah.
No, we understand what the intent was, and respect that you're trying to be a good steward of your investors' money. 100% understand that. But it is a little bit at odds with the 5%. And I've got it pulled up on the screen, just kind of what the standard is.
And two similar things as well. I am very, and I believe you may also be averse to if you have a closely held fund, like by a husband and wife, a loan from the fund to them, even if it's 18 months, because I tell the client, this is how I've stumbled, the word choice I've come up. The final determination of what is debt or equity is the IRS's, based on a 20-factor or a 12-factor test. And the client is always thinking, well, it's in the form of debt, it's a debt instrument, and it's and I remind them that in that 12-factor test, one of the factors is called either proportionate ownership, or it can be paraphrased as whole complete ownership. And basically, if the way in which the debt is loaned is also in the same proportion as the way that the equity is owned, then that, I think, is one of the more powerful factors that causes debt to be treated as equity. If you have and so if that notional loan from the fund to the owners is recharacterized as equity, you have an inclusion amount. And I mean, I understand that our clients wouldn't appreciate how risky that is. And of course, it's incumbent upon us to help them not do it. But if this were the only risk there were, then this would just be one of the things on my memo to a client. But there's a million ways you can screw up. And I, as we were talking, I was thinking, I think from maybe in a scholarly perspective, I'd be wondering if it's been picked up upon that there's something very unusual about the opportunity zone statute, in that it has this requirement, say, that assets be used in substantially in the way in a normal trade or business, and yet it is a tax motivated program, so it invites people to do something they wouldn't ordinarily do. Like, have we ever set people up for failure this way before, where we tell them to
Oh, I
put
would
their
say
left
the
foot
tax code
forward?
in general is setting people up for failure. I call it job security, but you know.
Yeah. And I hope this comment I'm making doesn't merely sound academic. I hope it gives you some inspiration for the feeling that if you have a client who's caught in some kind of a snare, who's being accused of, having a penalty, that you have the defense implicit in what I'm saying, that the statute is internally inconsistent. It asks for people to behave not consistent with the trade or business by putting all this money in, and then it tells them now behave consistent with the trade or business, and you can't have both. So anyway, we could say more, but we could
Sorry, and
cover
I
a
had
couple more.
skipped back to the non-qualifying definition. I think we were. Oh, do you want to go over this? I thought this might be. I don't know if you want
Yeah,
people to just kind of look at it, but I thought it was helpful.
yeah, I'd like to take some time on this. So let's say you do have a client who chooses to go with the projections, sources, uses, dates, and amounts. So I've created this example of what the working capital written statement could look like. And by way of contrast, I have seen written statements written by a lot of law firms, and they turn out to just be sort of jargony repetitions of the statute and regs. I don't necessarily fault them for that. I think they're facing the same problem we all are, which is that no one knows what a written statement's supposed to look like.
Yeah,
And
so they're
so
trying to
people,
include all the appropriate buzzwords to
yeah,
think, "Okay, I've covered my bases here." You know,
yeah. This is how you
like
take the bar exam, by the way. You just, if you don't know the answer to a question, you just say everything you know in a written, yeah, that's what they do. And so, but what I have conceived of here is, okay, I sort of describe this as a first in, first out system. The idea, and it doesn't say FIFO anywhere in the regs, but I believe that in order to be able to speak to when money is spent, you have to deem the regs to seek a FIFO system. And if that's the case, I think, and I've never personally kept track of FIFO inventory, but I'm assuming you have lines and a schedule of when the inventory walks in the door. And then you deem inventory to walk out the door in reverse order, in the same order. And that's what I seek to do here. And one reason this is helpful to have, we didn't get into this, but some of you may know that in order to get the 62-month period, any time that cash is contributed after the first cash is contributed, each infusion of cash gets its own 31 months. And I mean, you can't do that abusively. That the regs tell you that the cash has to be used for assets, and the regulatory text is quoted on a different page. But just in a non-abusive way, if money's going to come in to further the completion of your written schedule, then that infusion gets its own 31 months, and you can do that all the way up to a total of 62 months. And I think for some people who are getting close to that 31-month limit, it's helpful to keep this in mind. And it's helpful to keep in mind that this is true of any cash infusion, including, for example, if you have a construction loan. It's not just true of equity, it's true of money from debt. So if you're getting a construction loan and the lender is writing you a check every 2 weeks or so, and that cash gets 2 weeks, 31 months, and the unfinished tangible property gets to be grandfathered in for the entirety of that extra 31-month period. So this is what I would say if you wanted to have an anal version of a working capital safe harbor written statement. I think this is how it would be written. It would take the projections that the client's prepared, and then you would convert it into this first in, first out schedule. That's my shtick.
Well, and I think the whole idea of FIFO, first in, first out, is supported by the testing at the fund level, because you are looking at when the contributions first came into the fund, and you have a 6-month measuring period, and then you're looking at what comes in at the next. So you are assuming that any deployments, let's say by month 7, are, at least this is how we treat it, the first 6 months worth of cash went out by month 7. If something came in at you know, the beginning of month 7, you know, we will treat that as the next testing period, and that is supported. So I think the IRS kind of inadvertently supports the first in, first out.
Mm-hmm. Mm-hmm. Yeah. Yeah. Even though they don't say it, it's got to be true.
Yes.
Um,
And we
and
have
if you
about
do
5
it,
minutes left, just a heads
if
up.
you do it, you'll be the only person doing it. Um, yeah, you'll be, yeah, sometimes getting an A+ is not that much better than getting a B+. Um, and query whether you don't just want to get a B+, because that's a passing grade too.
Yep. Yep.
Do we want to look at the chat and see what kind of questions we're getting?
So it looks like I don't think we've
Oh.
gotten any. So one thing, just kind of as a heads up, we had gotten a question from the audience about how profits are treated. We don't have time to get into that, you know, how profits at the QOZB are treated. I did include a link to an article about that. I think there was one other question. Oh, this kind of touches on what we talked about with the non-qualifying property. Can I use the funds in any manner within the same fund while waiting to deploy per the working capital safe harbor?
There's a few things woven in there.
Yes. So
yeah, go ahead.
I was just going to say, so, well, when they're saying the same fund, I don't know, hopefully they're talking about the QOZB and and not the top tier fund, the QOF. I read the question as it was presented. So
maybe, yeah, maybe the way to do is just repeat the rules. The opportunity fund can have 10% of its property be anything.
Yep.
Kat told a story where the person did that and then the person earned interest.
Yep.
So, beware. I mean, look, but look, what if they had bought Tesla stock and the stock had multiplied by 7 times in value? I think, and this is not to be quoted as Reliance, but I think you and I discussed this and decided that it's a book value thing.
Correct. It's your basis. It's what you paid for it. So it wouldn't, even if it increased in stock, that's an increase in value, like think fair market value. But it is based on what you paid for it. So even if you have the market fluctuations and if for some reason you were adjusting your financials to fair market value, which is done quite often, that would not change your testing. And that's actually something that we account for in our version, our testing work papers that we use. You know, we take the starting balance sheet and we make adjustments. Another area where people get a little confused is, let's say I invest I'm the fund, I invest $1 million in a project that I get a K1 for. You know, and that K1 maybe in year 1 or 2 is spitting off like $1,000 loss, you know, just kind of some overhead expenses that are, so my $1 million investment might look like 990,000. Well, it actually isn't an issue because the testing is done based off of my original investment of $1 million. And then it would be reduced if I had received any distributions. But for testing purposes, you are using that cost basis.
Yeah, and I'm going to pull up an article I wrote in Bloomberg, which is just 1,000 words, where I cover something like this. But the principle that you're describing arose from corrections that were made to the regs after the final regs were made. And so, for those of you who read the Federal Register and are reading the final regs there, this principle won't be reflected there. In the olden days, the final regs said you had to value things every 6 months, and I think Treasury realized how impossible that was.
Disaster.
And so they modified the regs to do this. Yeah, I'll just put this link in the doobly.
Yeah, and so we have 1 minute left. I don't even think we got through it. Which was kind of what we expected. We might not even get through everything that we had planned on talking about because, you know, we just entertain ourselves with this. But anyone that has any questions, feel free to reach out to either of us. I don't know if our emails are on here. No, but here are our names.
Yeah, those are hyperlinks, so you could
Oh, we
click
got a question. Will there be another one of these? Funny you ask, because we were chatting, I guess it was last week, about how we just really enjoy talking about this amongst ourselves. So we talked about potentially making a little bit of a series of this. And as you can see, we really can deep dive and chat about very specific things. So audience, if you have ideas or topics that you would like, oh, they said we should. Yeah. If you have ideas or topics or pieces of this that you'd like us to dig into and delve into a little bit further, let us know.
Well, it's like catching the flowers that have been thrown at a wedding. Kind of puts you on the spot, but actually, Kat, I do want to do this again with you. This has
Yes.
been a lot of fun, and we'll come up with more topics, and I look forward to having another presentation with you.
Yes, this was a delight. Thank you all very, very much. We appreciate your attendance. And again, let us know if you have any questions. Okay, thank you.